Welcome to bizTV's Beyond the Brand. I'm Kelly Phillips. Today we're joined again by our accounting expert, Michael Reeder. Michael's CPA firm is dedicated to providing the full array of financial advisory services with a personalized, attentive touch. The Reeder team is passionate about helping entrepreneurs achieve financial success. Stick around for more Beyond the Brand. Managing your finances can be stressful, but it doesn't have to be. Our next guest is all about making your financial life simpler and more successful. We're here with Michael Reeder from Reeder CPA, and he's here to help us understand everything from tax strategy to personal finance. Thanks for being here again, Michael. Good to see you. Let's just jump right into it. A lot of business owners hear that everything is a write-off. How much of that is true, and what do people often get wrong about their deductions?
Absolutely. It's great to be with you, Kelly. The thing is that the tax code is written for the self-employed, right? So if you are a business owner, if you're self-employed in the eyes of the IRS, then there are more tax deductions available to you compared to, if you're just strictly an employee, whether you're a corporate employee, government employee, nonprofit employee. And so the tax code is written for the self-employed. There are more deductions, more write-offs available to you compared to if you are not self-employed. With that being said, not everything is a write-off, right? Going to the grocery store to just get groceries for your household is not a tax write-off. Going to the mall and getting clothes, for your kids for like back to school, that's not a tax write-off. And so there are taxpayers out there that write off everything under the sun. And there are those that are more conservative, and then there are those that are somewhere in the middle. But for things that are not write-offs that are being run for the business, those should get added back. Those should be considered shareholder distributions, right? Personal expenses paid from business. And then if you fall in love with that too much, you do run the risk of commingling your books. And so if you were ever in some sort of, if your business was ever in some sort of legal trouble, some lawsuit, et cetera, that could be justification for any plaintiff or creditor to pierce the corporate veil. So you don't want to be too aggressive with writing personal expenses off through the business if they're not really business expenses, because it could potentially come back to bite you.
And I think a lot of people don't understand, yes, meals can be deductible. You can write off some of those expenses, but it's not 100%. Is that one of the biggest misconceptions people have?
That's a good point. So for the most part, business meals, those are business meals and they're deductible up to 50%. And there's a difference between business meals as described and, like I mentioned, going to the grocery store for your personal household's groceries for the week. The latter is not even a business expense at all. The former is a business expense. You are going out with associates for a business meeting. That is a business expense, but it's only 50% tax deductible.
So just some things that folks need to keep in mind. Let's get into revenue versus profit versus cash flow. Many entrepreneurs assume that if sales are strong, that the business must be in good shape. But sales, profit, and cash flow all are very different stories. Can you explain why it's important for owners to understand the difference in the three?
Absolutely, Kelly. So in accounting, finance, tax, etc., terminology matters, right? So different words get thrown around loosely amongst people, thinking that they all mean the same thing, and they don't mean the same thing. So revenue, profit, cash flow, right? Three different things, three completely different definitions. Revenue is another term for sales, top line sales that your business is bringing in from customers or clients, right? Sales before deducting any expenses. Top line revenue refers to the sales coming in before deducting any expenses. Profit is your net income, right, after all expenses, right? So your revenue minus all business expenses equals your net profit, right? And then the third one is cash flow. There are three types of cash flow. There's operating cash flow, there's financing cash flow, and there's investing cash flow. And so, for example, you can have $1 million in your business bank account, but if that $1 million came from a business loan, right, then you have revenue of zero. In this hypothetical, you have revenue of zero, you have profit of probably a loss, right, and then but you have $1 million of cash in the bank, but it came via loan proceeds, which is one form of cash flow, but it's not revenue and it's not profit.
All right, good explanation. A lot of business owners decide that they don't need to talk to their tax preparer, their CPA, but once a year. Why is that not a good practice?
Yeah, absolutely. It's not a good practice because the magic happens with the magic happens in the conversations that you as the business owner have during the year with your accounting and tax professional, with your CPA. It doesn't have to be a monthly thing. It could be a monthly thing. It doesn't even have to be a quarterly thing. It could be and probably should be a quarterly thing. But if you just have a mid-year check-in and an end-of-year check-in at the very least, in addition to the whole January through April getting your taxes filed, then in that mid-year check-in and end-of-year check-in, and again, could be more, but at least a mid-year check-in and an end-of-year check-in, in addition to getting the taxes filed January through April, the conversation that is had during the middle of the year and end of year, and the strategies discussed during those conversations while you're still in the year can lead to executing those strategies, which can lead to thousands of dollars of tax savings. And it's all because you had a conversation with your CPA in the middle of the year and the end of the year, in addition to January through April. And so it seems simple, and it is. What happens is a lot of people just get busy with life and work, and a lot of small business owners wear a lot of hats. And so, accounting and taxes, at the end of a long day, you're working your business. You get back after a long day to the house. You're tired, you're hungry, you want to spend time with family. You want to, you got to go to sleep. But the last thing that you want to do is accounting and taxes. Have a conversation with your CPA. I totally get it. But to just time block at least a mid-year check-in and the end of year, if not more, thousands of dollars can be saved, because there's certain things that you have to do while you're still in the year that if you don't have your first conversation with your accountant until the next year, right, and the last time that you talked to them was, January of last year, then you're going to leave money on the table. So it's, again, it seems easy, and it is, but it's harder in practice for a lot of small business owners, because so many small business owners are so busy in life and work, wearing so many hats. But just that is why you want to have at least, if not more, a mid-year and an end-of-year check-in with your CPA, because you can save thousands of dollars in taxes just by having these simple conversations.
Are there certain questions that small business owners should ask their CPAs to make sure they're a good fit?
Yeah, great question. So first, so questions that you should ask your CPA to see if things are a good fit is obviously, what are the fees, right? And then also the client, you as the client, if you're listening to this, you should be asking your CPA, hey, are you a tax preparer, or are you also a tax strategist? Because I need more than just filing my taxes during tax season. I need some strategy throughout the year, right? And then that can, let the CPA answer, and, he or she provides their response. But you want to make sure that whoever you work with, whoever you engage as your CPA, that they are doing more than just filing last year's taxes. And that more is that proactive strategy that they're given throughout the year. And it's not, for a lot of small business owners, Kelly, it's not this crazy thing. Like, for a lot of small business owners, I'm talking a solopreneur doing a couple $100,000 a year to a small business doing, 1 to 10 million. For that type of client. And I know that a lot of you listening, you fall within that range as a small business owner and or self-employed person. There are 5 to 7 tax strategies that you want to make sure that you're keeping your finger on the pulse throughout the year. And if you're doing that, you're saving thousands of dollars in taxes. So you just want to make sure that your tax professional is a tax strategist, in addition to just simply filing taxes.
All right, Michael, we've got lots of other questions. Will you stick around? We need to take a quick break, but we'll be back to answer more questions with Michael Reeder. And we're back with Michael Reeder of the Reeder CPA Group. And Michael, can you kind of explain the difference? Because I know a lot of people go, I think I want to establish my own company. Would an LLC or an S-Corp be better? Can you kind of go through the differences in the two and how people should determine which is better for them?
Yeah, great question, Kelly. So entity structure strategy is something that we talk about a lot, that we advise our clients on a lot over at Reeder CPA Group. We work a lot with new entrepreneurs and entrepreneurs that are setting up second, third, fourth businesses. So entity structure, there's multiple things there are multiple things that go into it, right? So first of all, LLC. So we're big fans of the LLC over at Reeder CPA Group, and the LLC is a legal structure. By default, an LLC with one owner is taxed. So an LLC is a legal structure, okay? But an LLC is a hybrid entity when it comes to taxes, right? So an LLC with one owner by default is taxed as a sole proprietor. An LLC with two or more owners by default is taxed as a partnership. An LLC at any time, either at inception or subsequently, can elect to be taxed as an S corporation or a C corporation. So the ability for an LLC to change to elect how it's taxed in a variety of ways is a really cool, appealing feature for an LLC. And there are certain scenarios where you may want to start out as the default tax classification and then elect, for example, S corporation in year 2 or 3 once you're profitable. C corporation can make sense if you're doing something what's known as a rollover business startup, which is a type of entity structure that allows you to roll over retirement assets to fund your business, then you have to be a C corporation. And so, diving into all of that and what does that mean, et cetera. When does it make sense to, structure as a rollover business startup, aka Rob's C corporation? When does that make sense? If you want to potentially prepare for an exit, that the majority or all of the proceeds at sale are exempt, the capital gain at sale is exempt from capital gains tax, then you need to be a C corporation to potentially qualify for qualified small business stock. And then if you are an S corporation, the primary reason why you do that is to save money in self-employment taxes, also known as Social Security and Medicare taxes. So as you can see, there's, over at Reeder CPA Group, we go down the rabbit hole with all of our clients to see, when it comes to entity structure, what does it make sense to structure as and why, approaching that topic from the angle of strategic tax planning.
Talking about small businesses, a lot of people want to have that home office and they think they can have a home office deduction. Can you kind of dispel the myths on that?
Yeah, great question. So, the home office deduction is a thing. The thing about it is that there are lots of instances over the years where it's been abused by a lot of taxpayers out there, and so that's why the home office deduction has a bad reputation, so to speak, because the people that are claiming it, whether they're self-preparing their return on TurboTax and they don't know what they're doing, so they're just doing what they think is right, or they're being aggressive, or they work with a CPA, accounting tax professional that is more aggressive than they probably should be. It's just that the home office deduction is a thing, but it's it needs to be treated the way that it's meant to be treated, and just a lot of taxpayers out there have been aggressive with it, and that's why it's triggered audits and stuff over the past. But at the end of the day, if you have an office in your house, and it is so pretend that the IRS the IRS auditor is coming to your house in 2 weeks and they're going to audit your home office. They're going to want to see an actual room in your house that is a designated office, right? And so the square footage of that room divided by the square footage of your entire living space equals the business use percentage. And then that business use percentage, you can then take that percentage, and then you can prorate 100% of your property taxes, mortgage interest, repairs and maintenance, utilities, homeowners insurance, et cetera. And then you can get a little home office deduction for for the business use of your home. But the IRS will also tell you that a room that can also double as a personal living space, such as a kitchen, living room, finished basement, that does not count as a home office. So you can't say, oh, my kitchen's my home office because I sit at the counter, I sit at the breakfast bar in my kitchen, and I work from my laptop. Like, that might be true, but that wouldn't count for the home office. And so, you'll see people, say, well, my finished basement is my home office. So the square footage of finished basement divided by square footage of entire house ends up being like 30% of the, and so that would be an example of an aggressive home office. And so home office is a thing, just you have to not be too aggressive with it in order to, keep the men with black hats at bay.
Well, I think a lot of people have been using this expense and abusing it, so to speak, especially after COVID, because everybody was working from home. But if you didn't have that particular office space, could be a red flag for the IRS and could trigger an audit that you don't want. Some owners believe that you can wait until December to make some tax-saving moves. Why is it better to plan earlier in the year? And I think we kind of talked on this earlier, but we'll reiterate it because I think it is so important coming up on the end of the year.
Yeah, absolutely, Kelly. So December is better than April of next year because with the latter, it's too late, right? And so, but the problem with December is, like, if you wait until December, right, for like half of the month of December is shot for the most part because of holidays, right? So even if you want to do something, the client might be on vacation, or the CPA might be on vacation, or both. And so it's, or they need to coordinate with the retirement plan administrator, and the retirement plan administrator is on vacation, and so it's just, you get to December, like, it really like any sort of execution in December really should be the first half of December, because everyone starts to check out, right? It's already kind of, because of holidays, et cetera. So when I say, at the very least, if you're not doing quarterly or monthly check-ins with your CPA, you want to at least do a mid-year and an end of year. And that end of year really means Q4, right? So sometime in Q4, right? October, November, but then you have to be cognizant of Thanksgiving, Christmas, New Year's, et cetera. And so, like, Q4 is different than December. December could be pushing it. And so you want to, have that end of year be in Q4, preferably before December. And again, you've got December if you need to make some emergency things, but you just run the risk of it just, not being able to coordinate with all of the parties involved just because of personal holiday schedules.
Well, business owners sometimes worry about claiming too many deductions that would automatically trigger an audit. How should they think about that fear?
That's a good question. So I think it comes back to working with a CPA. So if you work with a third-party professional to file your taxes, then when you file your taxes, there's a section on the tax return that says, is there, third-party preparer? Yes or no? Yes. Reeder CPA Group or XYZ accounting firm, right? Just that alone plays a role in audit reduction, because the IRS, sees that and says, okay, they work with a third-party professional to prepare their taxes. So that return, like, in a vacuum, that return is, unless there's something crazy on it, like some aggressive position that triggers an audit, but just the presence of a disclosure that, hey, this tax return was prepared by a third-party tax professional, and that tax professional has the appropriate registrations with the IRS to prepare taxes, et cetera, versus a self-prepared tax return. The taxpayer just filed his or her own taxes on TurboTax and wrote off a bunch of stuff, right? Versus they wrote off a bunch of stuff, but a third-party tax preparer was involved. Thus, things that were written off were probably, maybe some stuff was scaled back or put into proper categories, or maybe some stuff was capitalized as an asset and depreciated, where, self-prepared TurboTax, it could just be like this, hodgepodge of just like the self-prepared TurboTax return is more likely to get audited, because the IRS is going to say, okay, like, this person did not work with anyone, so they probably did things wrong. that I see a $40,000 auto expense, that's probably a vehicle that they purchased that should be capitalized and depreciated instead of written off to auto. Or there's a $100,000 item in repairs and maintenance that probably should have been capitalized as leasehold improvements and depreciated over 15 years, versus just writing it all off in full, 100,000 as repairs and maintenance. And they didn't even work with a third party preparer on this. Yeah, so they definitely got this wrong. Let's audit this tax return. If you listening out there, if you're self-employed and you have all these write-ups and you're concerned, work with a third party preparer, because having that third party preparer, view it as a cost of doing business, because having that third party preparer disclosure on your tax return, just that alone mitigates audit risk.
And Michael, how can folks get in touch with you at Reeder CPA Group?
Yeah, absolutely, Kelly. So our website is a great way to get a hold of me and my team. So it's ReederCPAGroup.com. That's Reeder, REE, D as in David, ER, CPAGroup.com. Go to our website. There's a contact us section. Fill it out. Me and my team will reach out to you. We'd be happy to connect. I'm big on LinkedIn. My biggest social media presence is on LinkedIn. So you can just reach out, connect with me, and or follow me on LinkedIn. It's my first, middle, and last name, Michael Ian, IAN, Michael Ian Reeder CPA on LinkedIn. Connect with me on LinkedIn, and I'd love to. My team and I would love to connect with you.
Thanks, Michael. We always appreciate your time.
Appreciate you, Kelly. Thank you.
Thank you. Thanks for watching bizTV's Beyond the Brand. Be sure to subscribe to the bizTV YouTube channel, where you'll find full episodes of this show, a 24/7 live stream, fresh bizTV content, and a few surprises each week to help you stay inspired.